Morning, guys. It's Tuesday, May 6th, 5:24 a.m. Central Time. Grain markets are mixed this morning. July corn futures down 2.5 at 456 and 3/4. July soybeans down a half cent at 1045. July Chicago wheat up 3 3/4 at 535. July Kansas City wheat up 1.5 at 534 and a quarter. July spring wheat down 2.5 cents at 607. The corn market got absolutely clobbered yesterday. Let's start off there.
So the July 25 contract declined nearly 15 cents to settle near 454 per bushel. Rainfall across portions of the Corn Belt slowed planting progress last week, but overall corn and soybean planting are still above average. Planting is expected to accelerate this week as mostly dry conditions are forecast for the Corn Belt. Corn futures were also pressured on Monday following recent reports indicating near ideal development of Brazil's second corn crop.
We're going to look at some charts and some weather in a second. Before that, one thing that I'd like to make you aware of is that we have a big USDA report on Monday, the 12th at 11 a.m. Central Time. This is the monthly crop production and WASDE report. But in the May report, USDA provides us with its first official look at the new crop balance sheets for both the U.S. and the world. As it relates to corn, the numbers are going to be bearish. They're going to start with the trend line yield, which is going to be like a 182. They're going to paint, what they consider to be a normal situation for demand. And they're going to spit out a carryout number that's going to be north of 2 billion bushels. And no, that's not reality. And a lot can change before that becomes reality or could become reality. But it's going to be a carryout estimate north of 2 billion bushels printed on government paper. And it's not a good thing with regard to sentiment, even though it's not reality. To look at some charts, the July corn contract got beat up pretty good yesterday. You've fallen down into this long-term support zone. You've got a trend line that comes up off the August lows, and we are at risk of testing that maybe this week or as early as today. The December contract doesn't look good either. You've got some support perhaps in like the 440 down to 436 neighborhood. The spreads have been interesting and have been just as interesting as flat price. Old crop, new crop spreads got beat up pretty bad here the last 3 days. A lot of this is because the funds keep a lot of their length or positions in front months, and they were credited as being net sellers of like 23,000 contracts yesterday, and that was probably similar in prior days. So old versus new crop spreads got beat up. Part of that has to do with the perception also that, there's not a big problem with planting. And if new crop's going to be good, then maybe the old crop situation isn't as unsettling and the tightness isn't as worrisome for traders. I did throw a soybean chart in here as well. Soybeans have acted curiously well. We've been kind of range bound, and this is despite a trade war with our biggest soybean buyer. This is despite a pretty quick planting pace. Beans have held up well. Let's go to crop progress.
So the U.S. corn and soybean planting pace is ahead of schedule. Corn planting was 40% complete through Sunday, compared to 24% last week and 39% on average. Although planting remains above average, progress last week fell short of expectations, with analysts projecting 41% completion. In the Corn Belt, planting progress in Illinois, Iowa, Kentucky, Missouri, and Wisconsin remains below average. Soybean planting, meanwhile, was reported at 30% complete nationally versus 18% last week and 23% on average. Planting progress slightly lagged behind the 31% anticipated by analysts. With the exception of Illinois, all Corn Belt states are currently ahead of the average soybean planting pace.
Let's skip corn and go to soybeans really quickly. So you're at a near record planting pace for soybeans. You've only got one state of all the major U.S. soybean growing states that's below average, and that's Illinois. Now, part of the reason for this, you got to kind of read between the lines. A lot of farmers have switched to early soybean planting and planting soybeans before corn. And that's part of the reason why you've got this kind of disparity. Like soybean planting is very, very quick and near record, and corn planting is near average-ish. You got a whole bunch of states below average with regard to corn planting pace. Iowa's behind. Missouri's behind, Wisconsin's behind, Illinois is behind, Kentucky is behind average, Tennessee and North Carolina also behind average. So part of that's because of weather, but I think just as much of it, the reason that soybean planting is quicker on a relative basis than corn is because farmers are planting soybeans before corn. To look at weather, again, the next 5 days through May 11th, pretty damn wide open. Some pockets of Ohio and areas further east will see some rain. Parts of like Missouri will see some rain. And then the Gulf Coast and kind of the Southeast will see some rain. When you look at the 5 to 10 or out through the 10-day period, rather, still pretty dry. Some rains return to parts of Tennessee, Kentucky, Ohio, and then Missouri, but a lot of the Corn Belt's still dry. And then you've got some rains that return to some parts of the Corn Belt. So if you're in Illinois and you can get all of your crop planted here the next 10 days, and then the rains hit, that's a really good setup and a very good start to the growing season. So because of all of these things, the market is very clearly erasing some degree of weather premium. To give you a quick, different look at this, another map from our friends at Crop Profit, every major corn growing state is going to see below normal rainfall over the next 14 days. If this was the third week of June, this would be a very bullish forecast, but because it's the first week of May, this is considered to be a bearish forecast.
If you guys have not checked out our premium content, you sure need to do so. Joe, can you tell our viewers about yesterday's premium video?
How to follow the funds. I get questions probably every day about the funds and their positioning and how to track it. And I did a quick 7-minute primer on this yesterday. We ran through some stuff on the CFTC website. We ran through how we do the funds and what we send out to our premium subscribers on a daily basis. I think there's a lot of, I'm not going to say misinformation, but I think people are misinformed on how all of this works. If you guys want to see the premium stuff, go to standardgrain.com. You can sign up for the premium deal this morning. We send out 2 emails per day. The Standard Grain morning update is jam-packed full of info, headlines, charts, graphics, all of our premium videos, 6 most recent premium videos included. All of my cash grain marketing recommendations are included there. The midday blast includes that day's premium video. As I mentioned yesterday, what we do here for free on the podcast and on YouTube, this is a news show. We cover the news and the headlines. The premium subscription is meant for decision makers. If you're the decision maker in your farm operation, this is for you. We cover cash grain marketing. We cover policy. We cover crop insurance, all sorts of stuff that will help you to make those sort of decisions. You can sign up on your phone. It takes about 30 seconds. Google Pay, Apple Pay, Cash App, credit card, absolute piece of cake. All the videos are super easy to play on your phone. The emails are easily read on your phone. Give that deal a shot this morning, guys.
U.S. winter wheat ratings improved last week. As of Sunday, the crop was rated 51% good to excellent nationally versus 49% last week and 42% on average. The rating surpassed analyst expectations of 50% and also exceeded the 50% recorded during the same week last year. 18% of the crop is rated poor to very poor compared to 19% last week. The crop is 39% headed nationally versus 27% last week and 33% on average. The U.S. spring wheat crop is 44% planted versus 30% last week and 34% on average.
So winter wheat ratings are now 9% ahead of the 5-year average, I believe. And you've seen improvements in a lot of places because there's been some rainfall. The market was down yesterday, probably on the expectation for this, maybe more so because of the row crop sell-off. Spring wheat planting, there doesn't appear to be a problem. Pretty damn close to average when looking at this chart. Wheat futures have acted very poorly. We tried to rally on Friday, and you're hovering just above life of contract lows in this July HRW wheat contract.
Russian wheat prices declined last week. Export prices fell as the new crop neared market entry and concerns about frost damage eased. New crop wheat offers are currently hovering around $234 to $235 per ton, indicating expectations of ample supply. Last week, Sovcon raised its forecast for Russian wheat exports for both the current and next season. However, the agency does not expect a significant increase in export pace. Forecasters are calling for mostly dry conditions in Russia's winter wheat regions this week.
Russia is the global price setter, so when their prices are down, our prices struggle. That being said, U.S. wheat has reached levels where it should be competitive on the export market. We'd like to see some export business come in or emerge here. We heard some chatter about it last week that some importers were kind of sniffing around for U.S. wheat, and we hope that that is reality and that we can find some footing here in the market.
High beef prices are weighing on Tyson Foods. Despite stronger than expected second quarter earnings, shares of the meat giant fell nearly 8% on Monday as investors remain concerned about ongoing losses in its beef sector. The sector lost $258 million during the second quarter, marking the 6th straight quarter of losses. The losses come as the U.S. beef cow herd has shrunk to its lowest level since 1961, a factor that, of course, has driven cattle prices to record highs. As a result, Tyson's cattle costs surged by roughly $470 million in the first 3 months of this year compared to the same period last year. The meat giant, however, believes the cattle cycle's liquidation phase is nearing its end, with ranchers beginning to rebuild their herds.
I'm not a cattle person, Mackenzie. So long story short is that cattle are expensive and Tyson has to buy them, and that's why their profits are down.
Yeah, essentially Tyson, other packers, all of them, they have to step up and finally pay higher prices for cattle. But I mean, my goodness, the profits these packers have made in recent years, they're just fine. Their losses right now are hovering, I believe, around like $120 per head. But what they made during COVID and just a few years, I mean, a few years that we have for cattle producers with these high prices are not going to kill the packers. They'll be just fine. And their statement about the liquidation phase ending, I feel like we're a long ways from that, especially with a lot of dry conditions running throughout cattle country. Some people might be keeping some heifers back, but we're not going to see a boom anytime soon. And even if people are keeping heifers back, it'll be 2 years before those cattle come to market. So we're a long ways until we see an expansion of the herd.
The specific quote from the earnings call, Tyson Foods says signs are aligning for U.S. ranchers to start to rebuild cattle herd. What signs? Just
I guess I would say because we've gotten some rain throughout the Midwest. I don't know what
yeah.
other signs there are. And also with prices being so high, I mean, it's pretty easy just to send a bred female down the road or just feed her,
Mhm.
why not feed her? So I think that's a little far-fetched.
All right, let's go to inspections.
U.S. corn shipments declined last week, but remain strong. USDA reported that 63 million bushels of corn were inspected for export during the week ending May 1st. The print was down 3.5% compared to the previous week, but up 24% versus the same week last year. Soybean shipments were near the lower end of pre report expectations at 12 million bushels. The print was down 29% from the prior week and down 9.5% compared to the same week last year. Wheat shipments fell below expectations at 11 million bushels. The print was down 52% from the previous week and down 8.5% versus the same week last year.
Corn shipments still excellent, way above last year, still very, very strong. The front loading argument is dead. That's not what happened. This was the real deal in terms of the export program. Soybean shipments declining as they typically do seasonally. We don't ship a lot of beans this time of year. Wheat shipments, well, whatever. What did cattle do yesterday?
They were sharply higher. Live cattle were 95 cents to 255 higher. Feeders saw gains ranging from a buck 12 to 245. Box beef was also higher. Choice was 67 cents higher at 343.57, and select was 272 higher at 328.07.
Dow Jones is down 200 points this morning. The S&P is down 33. Bonds are off just a little bit. U.S. dollars a little bit lower. Crude oil is up $1.58 at 58.71 in the June WTI. Gold is up $70 this morning. Very, very strong. It was up yesterday as well. Everybody have a great day. We'll be back on Wednesday.